Hey everyone, and welcome to Sisters for Fi. Today we are going to answer the age-old question, what is the difference between saving versus investing? If you're new here, hi, my name is Catherine Agupjan. I am a financial educator, and here at Sisters for Financial Independence, we help you manage your money better so that you can live a life of impact today and tomorrow. Consider subscribing if you want more money lessons and personal finance content. Now, the words saving and investing are sometimes used interchangeably, but there is a big difference between them. And really, saving is all about keeping your funds, your money safe in an FDIC-insured account. It's less volatile and available for you to access in the short term. The challenge with saving, though, is that it has very low returns and there's a high probability that you will lose value with inflation. On the other hand is investing. And in this example, it's about investing in the stock market. And investing in the stock market normally provides higher risk, but potential higher returns. It is for the long term, and investing in the stock market has a higher likelihood to beat inflation. Now, both saving and investing take advantage of compound growth, and compound growth is all about your money reinvesting in itself and growing faster. So saving and investing both do that. The difference is just how often and how much is available to reinvest. Now, a big question that sometimes gets asked is how do we make money from the stock market? And we can make money in three ways. First is appreciation in value. So if a company performs well, that can get reflected in the stock price, and a positive change in the initial price and the price when you go to sell it, it can mean money for you. Now, this is definitely based on price you pay and when you sell it. The second way that you'll make money from it is through a dividend payout. Many companies, if they remain profitable, will give back part of their profits to shareholders as dividends. And that money comes back to you, and you can reinvest that money to buy more stock, which provides you more dividends down the line and potential appreciation in value. And the last is that if you buy bonds to the stock market, which is really a debt payment, if you invest in bonds, the borrower pays you interest on the loan or the bond until its maturity date. So you receive some payment of those bonds. Now, as we talked about this, I mentioned inflation. Inflation is the general rise of prices, which leads to a decline in your purchasing power. If you have been paying attention to the news in the past few months, you have heard that inflation has been on the rise, and it's been around 6 to 8%, which means that our purchasing power has declined, meaning some of the things we bought last year are more expensive today. And inflation will vary from year to year, but the general rule is that investing will beat inflation, saving will not. And I will show you a calculator that you can use to crunch some numbers so you can understand what actually this means in terms of actual dollar amounts. If you save in either a high yield savings account or an account with a lower interest rate versus investing in the stock market, which generally returns like 6 to 10%. All right, so why is saving important? Regardless of the difference, both saving and investing are still important. Saving provides you financial security. Knowing that you have money on hand, cash on hand in the bank can provide you a little bit of confidence and security. It will also buy peace of mind. And a big thing too is it guarantees income, right? You know that money exists. While that money may lose purchasing power, at least you know that it's there and it's not going to get wiped out by a dip in the stock market. And of course, a big part of this is to prepay future expenses. Maybe you have an upcoming trip that you need to make sure you pay for, or a house down payment you need to have. Saving in a safe form and accessible will ensure you have that money on hand for you to use. Why is investing important? The same reasons as saving, but some additional ones. One, you help guard against inflation. You can help build generational wealth when it comes to investing, and you can have more money to give back because your money is working for you and not necessarily you working for money. And it ensures that there's money that can grow by itself over time. Now what we'll do is switch to a calculator so that we can see the difference between saving and investing in real dollar numbers. Into the savings and investment comparison calculator. I will leave the link to this calculator in the description so you can try it out. But basically, this tool allows us to compare the results if we were to save versus invest. Now for the numbers here, we're starting at year 2022 this year and ending year of 2062. So 40 years time frame. And then for case 1, we're using that as our saving scenario. And case 2 is our investment scenario. We have the same starting balance, same year, 2022, that you were starting contributions, same annual contributions, same years contributed, but the big difference is the annual return. For savings, we are going to take the average of the current high yield savings account rates right now of 0.5 and 6% for our investment rate. This is conservative, but in the past few years, stock market has returned above 8%. So this will be something that is fairly conservative, but let's stick with those numbers and let's go ahead and calculate what that looks like. So for over 20 years, we're contributing $1,000 each to these accounts. And after 20 years, in 2042, we have our numbers, our final amounts. You'll notice for our savings, so case 1 scenario, we have around $22,084. And then if we jump to our case 2 scenario with investing, we have around $39,992. That basically is almost a double of our money, and that speaks to the power of investing. But now let's keep going forward and let's go another 20 years to see what happens. 2042, we jump to 2062. Now in this case, we are no longer contributing any money, nothing to our savings, nothing towards investing. We just let the power of compound growth kind of continue and reinvest that money. What happens 20 years later? We now have $24,400 in our savings scenario, but look at our investment, $128,262. So we definitely netted out more with the annual rate of higher rate for our investments. Of course, some years might be very good, some years might return a little bit lower, but the general overview is after so many years, there's a higher likelihood that you will gain more investing than you would with saving. So again, this calculator is in the link in the description, so you can do a bit of comparison for yourself to see how the numbers would pan out for you if you were saving versus investing. If this video has been helpful, give it a like and subscribe to Sisters for Fi, where we share money content every week.